Welcome to What is Venture Capital and Could Raising VC Money Be for Me? Hi, I'm Anna Collins, President and CEO of Jet Closing, and also a board member for Ladies Who Launch. And I'm thrilled, we're all thrilled that you're here to learn more and unpack what is venture capital and could it be for me? Some folks know, women entrepreneurs know, and non-binaries know they want to do venture capital. Others in our camp wondering, hey, I want to do hyper growth, and how do I do that? Should I do venture capital? But I want to keep my ownership, my equity. So what does that mean if I go venture capital? And so others are like, well, what is venture capital? So we're here today to unpack that and have an esteemed panel of guests who have been huge investors. They've been entrepreneurs, and I know we're going to get into it with them. I'd love to introduce them now. First is Allison Rosenthal. She's founder and managing partner of Lead Out Capital, which she founded in 2018. And Lead Out is an early stage venture capital fund with a focus on backing non-obvious, resilient founders on solving problems in overlooked and underserved markets. Prior to Lead Out, Allie was at Facebook, or now Meta, as one of its earliest business hires and a founding member of the mobile team. And today, Allie is also an active angel investor. Next, we have Lavina McMurky, who is general partner at international venture capital fund Movac Capital and an Edmund Hillary Fellow, a program to support exceptional entrepreneurs and investors to launch global impact projects from New Zealand. She came to VC as a career transition after spending 20 years working for global tech companies, largely based in the US, like Amazon, Microsoft, and Starbucks. And Lavina is joining us from New Zealand here today. Thank you, Lavina, for joining. I had a chance to work with Lavina at Amazon. She's fabulous, so I get to do a little shout out for her. And last but not least is Laura Ching. She's co-founder of Tiny Prints, a company she started after business school with a fellow classmate. And she founded it in 2004 and rooted in a deep passion for innovation, fresh design, and fanatical customer service. Tiny Prints grew from a tiny bootstrapped startup to a premier online stationery destination, generating over $100 million in annual revenue in 8 years, which is no small feat. Tiny Prints raised growth equity and was later acquired by Shutterfly. Wow, very cool. So let's get into it. You know, what is venture capital? And how would you define it? So I'd love to have each of you share your understanding and start with Allie on what is venture capital and how would you define it?
Venture capital is capital usually categorized in the kind of alternatives of the different asset classes. Typically, it's private money, private equity that gets raised by managers to go find businesses and founders in industries that are typically prone to supporting business models and products that can grow quickly with scale. Venture capital as an asset class can also be defined as one that is high risk, high reward. It tends to be early, riskier capital where an investor is investing for actual equity in your company or a promise for the investment to turn into equity, and in return for the risk that the venture capitalist is taking on early. Typically, company starts don't have a bunch of revenue or proven traction when venture capital is raised, but a big idea that can scale.
Right. It's all stages, right? So it can be early, just with an idea or seed stage, and go all the way through Series A, B, into late stage venture capital.
It's typically not a loan. It's typically in exchange for equity in your company, capital in exchange for equity.
Right. Giving up ownership, part of your ownership.
Yes.
Right on. Lavina, do you have anything to add to that?
Yeah, I'd probably agree with that completely, but tease out this idea of what does it mean to take equity instead of debt? Like, put it in real terms for you as a founder. If you take debt from a bank or some other lending institution, what they want is interest payments and the loan paid back, but it kind of starts and stops there. when you bring someone on as an equity owner, what that means is that you're signing up to have a business partner, right? And there are good things and bad things of having a business partner. On the good side, you've got someone that wants to take that journey with you, that should be there to provide you extra help, resources, moral support. But on the other side, they also want to have a say in the business. So they're probably going to sit on your board, they're going to have an opinion about your strategy and how you're executing, and in fact may even be deciding on how you're doing as a CEO from a performance point of view. And so one of the really critical things is to sort of understand it's not just money injected into your business, it's that you're inviting a business partner to join you on that journey, and that can be good and bad in different measures at different times.
Yes, that's well said. And when you talk about a VC, typically does one come in or more than one at a time?
Yeah, I mean, I think the best approach is often to have a couple of VCs come in at a time, because if you have just a single VC come in, then you can be quite vulnerable to whether that VC wants to invest in your next round or not. And also, it can be good to have a couple of VCs there for them to compete, because if things are going well, you want to be in a position where you have more than one VC that wants to follow on and put more capital into your company, and to having a couple of there so that they can both compete with each other and with external VCs, as well as they may have different times in their fund cycles where they want to follow on the investment or not follow on. Don't put all your eggs in one basket. On the other hand, it can be a mistake to have too many VCs in the mix, because then no one really feels like they're on the hook or accountable. So getting that right, usually it's a number between kind of 2 or 3 on any particular round is a really good approach.
Yeah. It's also important to understand as well that you don't have to sell all of the control to your VCs at all over the life of your building your business, or certainly at the beginning. And you might take VC funding early on where you're not ceding control, where maybe you're selling 10 to 15% of your business. You are building, you do, I think Lavina is right, you do want to identify people you want to work with and take strategic advice from and leverage for the purpose of building your business at scale. And I'll keep saying scale and hyper growth and growth, because that's an important consideration. But the first time you take on VC funding, unless you've really not negotiated a good deal for yourself, you're not giving up your business. I just want to be clear about that.
Mm-hmm, mm-hmm. Well, say, Allie, that's a good segue into what does a VC fundable business look like? What are some of the attributes or with a structure that of a business that are marks for, hey, this is a great business that VCs are looking to, the kinds of attributes that VCs are looking to fund?
Well, businesses that can be very, very large, that can grow to be at true scale, so can serve hundreds of millions of people. Say in the case of my former employer, Meta, then known as Facebook, or very, very large Fortune 100, 500 enterprises. Typically, venture capital businesses and business models, and the products that are built and the business models that grow up around them are typically software-driven businesses, and therefore have high margin and can scale distribution-wise as well as organization-wise in a margin in a really nice high margin way. And then there can also be more kind of frontier tech and other types of technology, innovation, biotech, hard tech, frontier tech, that might require a lot of R&D costs at the beginning to develop your product, develop the IP, and then take it to the market at scale, which can require some high upfront costs. And venture capital is often very effective in getting you, a large round of initial funding to go do that work and pursue that plan and execute and prove out what's called product market fit. So those are venture capital advantages, and some shape, to think of the contours of why you might take venture capital. You'd also want to ask yourself from the beginning, is my business something that I just want to have enormous scale with, and then ask, how do I get that scale as a technology business? Again, typically VCs go after technology-driven or enabled products and business models.
And that's because they can, with some investment, get to great scale, 100 million plus, in a period of time for them to get their returns back. Is that right?
Yes.
Yeah. And Lavina, I want to get Laura into you. You didn't take VC money early. You bootstrapped, which to get to 100 million by bootstrapping is again quite a feat. So can you talk about how you decided not to take VC money early?
Yeah, I mean, I feel like Tiny Prints is a bit of the antithesis of what Allison was describing. Back in 2004, a couple of my partners and I, we got hit by the entrepreneurial bug. We were 3 years out of working in the corporate world and just really we were drawn by the idea of kind of building a company together as friends, doing it on our own terms without any outside investment, and had big dreams. And I think back in that day, we were a bit jaded by overfunded Silicon Valley companies. And so it's really important for us to maintain control of our startup early on. And back in that time, if you remember, funding was severely limited. So you add severely limited funding with a bunch of new entrepreneurs with not a deep, shiny resume. It just made sense for us to bootstrap. And so from the get-go, I think it made us focus on finding a business idea that was bootstrappable, that we could, from almost day one, have a positive cash flow and do that quickly. And so once we evaluated business ideas, we came up with Tiny Prints. And Tiny Prints, in a nutshell, is custom stationery, online, premium stationery. And so it just fit, right? That category is high margin. We were able to target to new moms in a very niche customer segment. So we were able to market efficiently without a lot of dollars spent. And back then there were not many competitors. And so we didn't have to worry about putting a ton of money. And so Tiny Print started with $10,000 of our, combined savings. And I think, we were profitable from day one, and it was a lot of fun. And I think what bootstrapping does, one pro that I saw right away, was that it forced us, to be scrappy, to be budget conscious. We were counting our pennies, we only had 10,000 pennies. And so also to be focused and disciplined on narrowing in on one product. And back then for us, it was custom birth announcements and spending the time with our customers to perfect it and roll it out to the market and be patient about it without any outside influence or maybe impatience from an outside investor. Yeah,
that's, I love that story, that focus. If I've learned anything in doing different ventures, it's that focus is fundamental and often easy to not do, especially when there's VC money in the house. And so Lavina, Allie talked about tech being tech kinds of businesses, biotech tech, hard tech, software tech. And Laura talked about picking a product that, again, was using technology to do on-demand birth and stationery. What other kinds of businesses? I mean, now I'm out there in the audience. I'm thinking, I don't have that kind of business. What other kind of businesses potentially could you think about doing VC? And if an entrepreneur came to talk to you, what are some of the initial questions you would ask to filter that they could explain?
Yeah, I think it's good to sort of say, well, what is it about tech that makes that so commonly funded through venture capital? And a lot of it's because we call it sort of the scalability, but you've got a lot of upfront cost to develop the product, so that's an R&D expense. But once you've paid for that, the marginal cost of selling that thing to one more customer is actually quite low. And so these are companies that in the early days basically are burning cash. And if you can get them to a certain point of scale, then that flips and they start generating a tremendous amount of cash. And that's really the kind of characteristic I think that VCs are looking for and VCs like. On the other hand, if you have a business, maybe like Laura's in the early days, that actually generated profitability and cash from day one, then bootstrapping, if that's an option for you, is always going to be a better way, because equity capital is really expensive. And I think, to pick up on Laura's story, what she did was kind of really smart.
Yeah.
Because the other thing about equity capital is, if you raise it in the early days when your company is starting out and isn't worth very much, then you're taking on a lot of dilution because the valuation is low. And so raising it too soon is sort of one of the, I think, mistakes. If you can bootstrap early to try and get the business up and running, prove out product market fit, figure out how you're going to go to market, and get through those early phases with phases with either bootstrapping or friends and family or your own capital, and not have to sell a portion of your company. Really great strategy. And then later on, you can start to say, okay, have I now proven out there's a market here? I can see it. I know how to go after it. Maybe I want to accelerate. So you may then potentially later on, flip to want VC to accelerate something once you already feel good about what you've got. I don't know if you want me to talk about what we look for at different stages, or just pause.
Yes.
For others to jump in.
Well, Laura, do you have anything to add to what Lavina just said? Because I was thinking about the product market fit question, and one of the questions I add to our transactional customer surveys that we do at Jet is, how indispensable is Jet closing to you on a scale of 1 to 5? And so, it's like so indispensable. Like Amazon Prime is indispensable. We would all not be happy if we couldn't use Amazon Prime. I know that because you're all customers. But are they going to say that about, that's true product market fit, right? You're not going to use it. And so that's a 5 out of 5 stars. And so how do you know this product market fit? And Laura, you were getting that early feedback and tweaking. What else would you say about that as you were bootstrapping and growing? Because that is like fundamental to what Lavina just shared.
Yeah, I think if we were to take on VC money at first, I'm not sure that we would have got to the right product market fit. And the reason being is that back in 2003, e-commerce was still being developed. Personalized items were being developed. And so we needed a lot of time to figure out just what mattered to our customers. And it was fanatical customer service. We had 4 eyes of QA on every card before it went out the door. Just the quality of the paper. We spent a lot of, probably too much expense on that side, just finding product market fit. Whereas I think if a VC were to come in, they might have had a different idea about what that product was. And so it just gave us the freedom to test and to fail a lot too, before we finally found the right product and then brought them in, 3 years later, when it was, we were much more confident and had the data to back why this product made sense for the market.
Yeah, got it. Thanks.
By the way, that's something that we actually look for at VC, and in my VC as well. My fund is this customer segment expertise, which it can be really hard to develop if you take venture capital too quickly. Yeah. And it's more like, is my business, does my idea sort of check the box? Is it visionary enough? Is this how I'll return money? But if you can actually show up, I think whether you go to venture capitalists or the small business, administration for a loan, or you do revenue-backed financing with that expertise that Laura was talking about your customer, you are so much better positioned to pick your sources of how you're going to fund, whether you want to stay more focused and be cash flow positive to extend and expand your business, or if, when you've hit upon something, you see the opportunity to go for scale, to beat maybe the competition, or to take on, different markets where you're feeling that pull from that potential, founder, or so that product market fit. And we really look for in our founders is like that founder market fit, where does this entrepreneur really understand a pain point in a marketplace that they know well? Do they really understand the customer needs so much so that they could point to the thing that the customer has hacked together to solve the problem for themselves? And then I think no matter who you are as an entrepreneur, if you know that, you will have choice with respect to how to finance your business. And then you have to think about, okay, do I want a partner? Do I want what typically venture capitalists promise, do I want to give up my equity in exchange for that, potentially in exchange for scalability, or do I want to go a different route and still create an amazing business? And so I just want to augment, and the one entrepreneur, product entrepreneur on our panel. Like, I just love that, that yes, you were forced to focus, but look at where you gave yourself optionality, which is terrific, which is where you want to be, I think.
Yeah. Absolutely. No, I love that. And so we've started to talk around some of the, the bootstrap versus VC money and the pressure points. Lavina, do you have thoughts on what are some of those once you're in a relationship with a venture capitalist, or a few, like is common? What are the pressure points? And we've been talking about, and kind of as a second part to that, we've been talking about raising money, when the truth is you're always raising money. I can tell you. Once you get in the game, right, it's like recruiting. You're always recruiting. It's just, are you active? Are you passive? What stage and what money are you raising? So can you talk a little bit about that and the expectations and the milestones?
I think one of the most important things I'd say is, that with people who go out to raise venture capital, sometimes with founders, you fall into this trap where you want the biggest possible valuation, right? You raise the most money and the biggest possible valuation, as though that's a measure of your worth. And I think media exacerbates that, because all the headlines are about the startup that just raised another 200 or 100 million, and becomes this almost like this way of measuring your worth through the size of your raise. And I think what founders don't necessarily immediately get is, if you raise a really high valuation, what that means is the VC that just invested in you, that's their baseline. Now they're expecting you to do, between 10 and 100 times greater than that. And they are going to come onto your board and push you really hard to go and get that growth that meets their own financial model. And for some businesses, that might be the right thing, because you're capable of it and you need someone to help you set big goals and go after them, chase them hard. But if that's not the right thing for your business, then what that sometimes can turn into is the VC pushing you towards almost unnatural ways of growing, because they're trying to be able to get their investment case to work out. And what that often shows up at is companies over hiring on the hope that putting more capital against the business will drive a higher growth rate. But often you should have growth and then put capital against it to accelerate it. Putting more capital into a business doesn't necessarily make it grow that much faster. And so I think one of the most important things is to say, hey, what growth do I really think I'm capable of? How much money do I need? And don't go and raise more than that. Don't optimize for the highest valuation, because highest valuation just means more and more pressure to grow your business, sometimes in an unnatural way. So be ambitious, but be realistic, and don't let yourself get pushed into taking too much capital because it makes you feel important. Right now, VCs have got a ton of money in their pockets, and the problem we're solving is, how do I deploy as much capital as I possibly can, because I've got so much money sitting that I need to invest. But that, as a founder, don't fall into that trap. Only take the capital that you need, that you really think you can use to grow in a sort of profitable, positive ROI way.
Yeah, thanks. That's a lot of that resonates from my experience. I'm having so much trauma from doing it the wrong way in experience. What about the KPIs? Like, you talk about that I love what you said about, the more capital in doesn't create the growth. You have to growth and then the capital behind it. Well, how do you identify that moment? Like, what do you look for?
What do I look for? I mean, it depends. It depends on the sort of the industry, the segment, the kind of solution. But we, at a stage level, if it's very, very early and this is your first institutional round, I think, what we look for again is that customer segment expertise, is that evidence of really understanding a pain point in a market. At more of the seed round, if you've actually got a product, an MVP that you're out testing, is some customer traction, maybe some revenue, depending on which kind of customer you're going after, whether it's an end user being like an enterprise or an enterprise, user versus a consumer. And then kind of at later stages of growth, I mean, it's the core financials, high margin, contribution margins, eventually profit margin. It's cohort analysis where you see how quickly you are potentially adding users to your product, paying users or engaged users over time. Are they retaining? There are a number of different ways at different stages of company evolution that venture capitalists will use to evaluate your business. So it sort of depends on the stage that you are building and executing on and executing on the business model when you are raising. At the very early stage, we're not typically looking for a ton of revenue. The expectation is you're just getting going, and maybe you are just shipping the product for the first time. And then at later stage, Series B, Series C, it's much more financial statement, financial model driven, high margin, growing fast, revenue kind of doubling annually, depending again on the product and the industry that or the segment of the industry you're selling to.
Yeah, thanks.
Yeah, I think VCs often use revenue growth as a sign of traction, and it is a good indicator of traction. But, a good VC is going to pick underneath that revenue growth. And what we always look for is to go to the actual customer and see how important is this solution to them. One of my recent investments, as an example, had Walmart as a customer, and I talked to the VP at Walmart in that line of business. He said to me, when I saw the solution, I almost cried at how good it was. And I'm like, I'm investing in this company. Hearing that, like, it's not just a little bit better than the competition, it's, way better than the competition. And then I think the other thing I look for underneath revenue is a sense of repeatability. Like if the revenue's there and you talk to customers, but they're all buying it for a different reason, then it feels like maybe the product market fit isn't quite there. So we look for hearing the same story from your customers, strength of conviction and how much your customers care about your solution as a couple of things that are really important. And then on your sales method, have you just got there through opportunism, maybe founder-led sales, or do you really have a go-to-market motion that's also repeatable? Because once you've got all the customers saying the same thing about the product and you've got a sales motion that you can just repeat, then that's a business that's ready to have capital poured into it.
Yeah, love that. I can see those spinning. So what does it look like once, this is great. Well, I have one more question on the time horizon. So you said don't take too much money. It's kind of getting Goldilocks. You want the right amount of money for the stage and where you are. And how do you know how much that is? Because you're going to run out of money. Like you're doing a business plan, and then these we're talking about these different stages. So can you say what's a runway of money that you would typically expect to if you're an entrepreneur? How to think about that?
It's different at different stages. If you're an early stage company, then because there's so much you're still trying to figure out, you can only see so far into the future. It can be common that for pre-seed or seed, you only are looking for a year of runway. The valuation's lower, and so you don't want to raise a longer runway because, again, you're taking a lot of dilution. So better off that you make progress for a year, you get more information for your investors and come back around and do another raise. As you go into sort of later stages and start to be having kind of revenue in your company and be kind of more mid-level, then usually having 18 months to 24 months of runway is a good idea. I hear some companies that come and say, look, I'm doing a massive raise because I don't want to have to raise again in 3 years. So I'm going to raise it all now, and then I'll have enough money in the bank to tide me through. But be careful, because companies like that, when they've got the money sitting in their pockets, they often don't put it to the best possible use and kind of get pushed towards that idea of let's spend it faster. So just, I think, be really disciplined about how much you raise and don't over raise, thinking that you.
Yeah, I also think you want to test. You want to test hypotheses with each round of financing. You want to hit certain milestones. You want to launch certain products. You want to hit certain customer segments. Write a hypothesis and then design a bunch of tests to see whether or not your hypothesis can be right, and construct a financial model around that. How much is that going to cost you in engineers or in product builders or in marketing dollars or in sales motion, and back into it that way. Have a bottoms up plan, to reemphasize the focus, from the discussion earlier.
Love that, Allie. And it's, again, very Amazonian with that hypothesis and testing. What, an entrepreneurial mindset in general, one last question. VCs aren't just capital. They help accelerate growth, right? What are a couple other things that VCs are going to benefit someone raising VC money?
I mean, I think because they're a business partner, what I'd really encourage everyone to do is have a conversation about values. What does this VC stand for? Do they have the same view as you do around the business and what it's capable of? And that might be in terms of the length of time you want to stay in it, whether you're looking for an early acquisition, make sure that you align on a values and a strategy point of view. Because if you take a valuation that might be the highest valuation, but don't have the same outlook for the business or goals for where the business is going, then it's going to be a painful business partnership. So have, questions around what value will you add, but I would actually start with values and expectations, probably is the first questions I'd ask. And do diligence on your investor. They're doing diligence on you, and so you should be doing diligence on them to make sure they'll be good business partners for you.
Right on.
Yeah, all of those, I would just add, it's a relationship, and it's a relationship, again, starting with values and diligence, but that's, depending on when you raise, can last for, a decade, sometimes more. And so, do you like this person? Do they like you? Spend time if you can. Some of these rounds happen so fast now, and you end up with a partner that you don't really know well. And, what are people like under pressure when things aren't going well? Yeah. Because it's early stage, entrepreneurship, things typically don't go well more than they go well. And so, how does someone support? How does someone behave? Because, once they're on your cap table, you're stuck with them, and vice versa. So it's, really building a relationship, I think, early. And, to Lavina's point, starting with values. I'm curious to hear from Laura.
I think from the entrepreneur side, have an honest conversation with yourself first about how much you really want a partner involved in your business, especially if you start at bootstrap, right? I think it can feel sexy and that you need a lot of help, but define what you need help in. I'd say is one thing. Yeah, and I think it all comes down to fit. So from the entrepreneur side, ask questions about what type of portfolio companies they work with. What's the profile of the entrepreneur? For us, were they used to working with more family-run businesses? What kind of day-to-day do they want you to check in every week, or just at board meetings? What do those board meetings look like? How are they going to weigh in? Are they more about helping you grow or cut costs? And what matters to you? I think all those are super important to ask the hard questions first so that you get into the right relationship.
Yeah, great. Well, I'd like to, that we're out of time. I'd like to thank all of you, our esteemed panel, for sharing. I know I'm inspired, so thank you, and take some of those nuggets with me. And thank you, all of you attending. We appreciate your time. And there's a lot more with the summit, and make sure to stay around for the next session, which is Bring on the Angel. Thanks all.